with that markets update now. The local exchange will be contending with subdued global markets this morning, coming off a volatile week for global markets when investors were digesting the U.S. Federal Reserve's policy signal and the potential collapse of the Evergrande. Now, Jimmy Moyaha, independent analyst, joins us now to talk us through the latest market moves. Mr. Moyaha, thank you very much for making the time. Give us your sense of how the markets opened in early trade.
Morning, Chloe. The markets opened somewhat upbeat this morning off the back of, as you said, the volatility we saw last week. Last week we did see interest rate decisions out of the Bank of England, out of the South African Reserve Bank, as well as out of the US Fed. So we did expect to see some level of volatility leading up into those rate decisions. And we are looking ahead this week to see what the US Fed's chairs are all going to report back on when they have their meetings. We've got a couple of them speaking this week, including the Fed Chair, Jerome Powell. So we are expecting to see some continued information around policy decisions, policy outlooks, and that sort of thing. We have seen the SA40 trading up about 1% in early trade this morning. This off the back of last week's bounce off that 54,500 or so odd points mark for the SA40. So finished bullish last week. We are seeing a continuation of that in this time at the moment.
Yeah.
The Rand is heading towards that 15 Rand mark that we've been eyeing for quite some time. It's currently at around 14.96. So it'll be interesting to see how that develops as we continue into the week.
Yeah, let's talk oil prices rising for a fifth consecutive day in early trade with the Brent heading for the $80 amid supply concerns as part of the world, as you will remember, see this demand pick up as the pandemic conditions begin to ease. Talk us through those sentiments and what is driving that sentiment.
Of course. I mean, what we've seen with oil as well over the last couple of weeks and months as well has been the OPEC Plus countries have made it very, very clear that it is in their best interest, and this is what they will continue to do, is they'll continue to see if they can maintain price stably above the $70 a barrel mark. Of course, we know as the oil price comes lower, it becomes financially unsustainable for the oil producing nations to continue to produce. And they've eyed that $70 a barrel mark to say that that is where they want to keep the oil price above. We've also seen some developments out of the U.S. We saw the lowest crude oil inventory numbers since October of 2018, I believe, just off the back of the hurricane that hit the Gulf of Mexico, and that was affected the oil production out of that side as well. So from an oil price perspective, I mean, globally, the demand has been plateauing for the last couple of months. And this is largely off the back of, one, China's demand slowing down, two, international travel being on the slowdown, which could have a positive effect now as we go into sort of southern hemisphere summer. We could see international travel start to pick up, and that could fuel the demand for increased oil prices. Locally, of course, we are looking at the fact that our mining sector might be looking to go into alternative energies and that sort of thing around that, and that could have an effect on our local side of things. But of course, I mean, we've seen that we've had negative oil fuel prices. We've had some of the highest fuel prices we've seen in recent times because of the current oil price situations, and largely because of the fuel price tariffs. But I mean, I think the concern at the moment from a global perspective is whether or not the Q4 demand will return as robustly as originally anticipated. We've seen a couple of countries revise down their GDP outlooks for the end of the year. We've seen businesses revise down their performance outlooks. And we've seen the same in the oil space, where the oil prices or demand isn't expected to be as robust as what was initially planned, because we're not at that ideal point where we thought we would be in terms of global recovery from the COVID pandemic.
Yeah, let's talk Eskom matters, Jimmy. You will know that a discussion, or should I say a discussion paper published by the energy regulator, NERSA, has called for a complete overhaul of the way that Eskom's tariffs are set. Now, it proposes a move away from the current revenue-based approach to determine these electricity tariffs in South Africa to a cost to save, or cost to serve rather, approach. How feasible is this option?
So at the moment, I think we'd need to look at the implications of a change in the structure. I mean, if we look at Eskom's performance over the last 10 years, electricity prices have increased by 175% odd. Electricity sales from Eskom have fallen by 14.7% in that same time. So whatever Eskom is currently doing is clearly and has been unsustainable for quite some time. So a new proposed structure is something we should definitely be looking at. Whether or not this structure is the one to solve the problem remains to be seen, because I mean, under the proposed structure, there's a couple of moving elements and moving parts to it. There's the fact that each power generating unit will be now a separate unit, and the units will then be managed and run separately and all of that. And while that does present itself with a better solution to what we have at the moment, the downside to that could potentially be that because each unit is then allowed to mark up their individual tariffs themselves, you could have a situation where you've got a markup on top of a markup instead of what you used to have where there was just one general markup on the entire production. So that, of course, I mean, NERSA has outlined that that you'd want to ring fence the tariff there, the tariff limits there in terms of the margins there, and see if you could possibly keep that under control. But again, that now opens up a whole different sector of problems that we might need to deal with in that respect. And it still doesn't speak to the fact that will Eskom be able to meet up with demand, and will the increase or the allowance for alternative generation be increased in that respect? So at the moment, Eskom being the sole power utility or the main power utility generator in the country, that in itself is an unsustainable model, because we've seen that Eskom is currently in debt, and they are looking to get themselves out of that debt at the expense of consumers in some respects, whether it's by way of load shedding, by way of increasing tariffs over the last 10 years, or however they're structuring that. There has been talk around the mining space as well. I mean, the mining sector space has said they're looking to come together possibly to fund almost a $3 billion rollout plan to see if they can get the mines to go off-grid. Now, that would have positive effects in that demand would come off, or the pressure would come off of Eskom's demand grid. But at the same time, the mines have been paying their Eskom bills and that sort of thing, so revenue's coming out of Eskom's pocket there. I think at the moment, in terms of one needing to address the financial sustainability of Eskom as an entity, alternative power generation still needs to be a conversation to be had, and the conversation around possibly semi-privatizing Eskom to avoid future mismanagements still needs to be left on the table. I don't think this type of solution is a solution that then says, okay, we don't need to look at anything else, we're going to deploy a different model, and that'll solve the problems. I think Eskom's problems, many as they are, need to be tackled on many fronts at this point.
Yeah. Let's talk Namibia's growth, Jimmy. It's a country just next door to us. Its economy grew by 1.6% quarter on quarter, particularly in the second quarter of 2021. This, as several sectors bounced back from the devastating performance during the same time last year when that country was in lockdown. What is driving growth in Namibia?
So, I mean, on the Namibian front, we need to take into account that while the growth was rather positive, the estimates on this growth were revised down, and the performance of last year, the contraction of last year, was about 8.5%. So the Namibian contraction that happened in 2020 was more severe than the contraction that we saw in South Africa. We did see some positive sectors or some expansionary sectors. Of course, we saw the wholesale and retail sector report some positive numbers. We saw the hotel and restaurants report some positive numbers. What was interesting to see in the Namibian reports as well, the sectors that reported the strongest numbers were also the sectors that had the biggest contractions in the previous cycle, so in the Q2 of 2020. And what we've seen still that the recoveries and the rebounds that we're experiencing now are still lower than the Q2 of 2019 levels, so pre-COVID levels. So even though the recoveries are there, or the rebounds in the GDPs are there, they're still not at pre-COVID levels. And one of the sectors to note was the financial sector. I mean, South Africa, if you compare South Africa and Namibia's financial sector, so Namibia's financial sector actually contracted in the last reported numbers, whereas South Africa's financial sector has been rather strong in that respect. So Namibia's numbers at the moment are looking rather positive, but like I said, it's from a point where they had revised them down. Initially, Namibia had also said that they're expecting 2.7% GDP growth, and they've since revised that down in their mid-year revision down to 1.4%. So that revision alone says that they had anticipated, or they're now anticipating less than half of what they originally expected, which again speaks to what we've been discussing around the global theme in everything, is that we're not recovering at the rate at which we thought we'd be recovering. The oil sector is not doing that. The global markets aren't doing that. Global equity markets aren't recovering at those rates. So it speaks to a greater thing where we did say this coming out of COVID, coming out of 2020, that 2021 might be a good recovery year, but it might not be as robust as everybody had anticipated. And Namibia is another telling sign of that, but so is the global economy, or the global sentiment around markets as a whole.
Yeah, Jimmy Moyaha, thank you very much for your time and, as always, your insights. Independent markets analyst joining us there.